Introduction to insurance. Types of life insurance. Life insurance protection comes in many forms, and not all policies are created equal, as you will soon discover. While the death benefits amounts may be the same, the cost, structure, duration, etc. vary tremendously across the types of policies. Whole life. Whole life insurance provides guaranteed insurance protection for the entire life of the insured, otherwise known as permanent coverage. These policies carry a cash value component that grows tax deferred at a contractually guaranteed amount, usually a low interest rate, until the contract is surrendered. The premiums are usually level for the life of the insured, and the death benefit is guaranteed for the insured's lifetime. With whole life payments, part of your premium is applied toward the insurance portion of your policy. Another part of your premiums go towards administrative expenses, and the balance of your premium goes towards the investment or cash portion of your policy. The interest you accumulate through the investment portion of your policy is tax-free until you withdraw it, if that is allowed under the terms of your policy. Any withdrawal you make will typically be tax-free up to your basis in the policy. Your basis is the amount of premiums you have paid into the policy minus any prior dividend paid or previous withdrawals. Any amount withdrawn above your basis may be taxed as ordinary income. As you might expect, given their premium protection, these policies tend to have a much higher initial premium than other types of life insurance. But the cash buildup in the policy can be used towards premium payments provided cash is available. This is known as a participating whole life policy, which combines the benefits of permanent life insurance protection with a saving component and provides the policy owner some additional payment flexibility. Universal life. Universal life insurance, also known as flexible premiums or adjustable life, is a variation of whole life insurance. Like whole life, it is also a permanent policy providing cash value benefits based on current interest rates. The feature that distinguishes this policy from its whole life cousin is that the premium, cash value, and level amount of protection can each be adjusted up or down during the contract term as the insured's needs change. Cash value earns an interest rate that is set periodically by the insurance company and is generally guaranteed not to drop below a certain level. Variable life. Variable life insurance is designed to combine the traditional protection and savings features of whole life insurance with the growth potential of investment funds. This type of policy is comprised of two distinct components: the general account and separate account. The general account is the reserve or liability account of the insurance provider and is not allocated to the individual policy. The separate account is comprised of various investments funds within the insurance company's portfolio, such as an equity fund, a money market fund, a bond fund, or some combination of these. Because of this underlying investment feature, the value of the cash and death benefit may fluctuate, thus the name variable life. Variable universal life. Variable universal life insurance combines the features of universal life with variable life and gives the consumer the flexibility of adjusting premiums, death benefits, and the selection of investment choices. These policies are technically classified as securities and are therefore subject to Securities and Exchange Commission (SEC) regulation and the oversight of the State Insurance Commissioner. Unfortunately, all the investment risk lies with the policy owner. As a result, the death benefit value may rise or fall depending on the success of the policy's underlying investments. However, policies may provide some type of guarantee that at least a minimum death benefit will be paid to beneficiaries. Term life. One of the most commonly used policies is term life. Term insurance can help protect your beneficiaries against financial loss resulting from your death. It pays the face amount of the policy, but only provides protection for a definite but limited amount of time. Term policies do not build cash values, and the maximum term period is usually 30 years. Term policies are useful when there is a limited time needed for protection and when the dollars available for coverage are limited. The premiums for these types of policies are significantly lower than the cost of whole life. They also initially provide more insurance protection per dollar spent than any form of permanent policies. Unfortunately, the cost of premiums increases as a policy owner gets older and as the end of the specific term nears. Term policies can have some variations, including but not limited to annual, renewable, and convertible term. This policy provides protection for 1 year, but allows the insured to renew the policy for successive periods thereafter, but at higher premiums without having to furnish evidence of insurability. These policies may also be converted into whole life policies without any additional underwriting. Level term. This policy has an initial guaranteed premium level for specified periods. The longer the guarantee, the greater the cost to the buyer, but usually still far more affordable than permanent policy. These policies may be renewed after the guaranteed period, but the premiums do increase as the insured gets older. Decreasing term. This policy has a level premium, but the amount of the death benefits decreases with time. This is often used in conjunction with mortgage debt protection. Many term life insurance policies have major features that provide additional flexibility for the insured policyholder. A renewability feature, perhaps the most important feature associated with term policies, guarantees that the insured can renew the policy for a limited number of years, i.e. a term between 5 and 30 years, based on the attained age. Convertibility provisions permit the policy owner to exchange a term contract for permanent coverage with a specific time frame without providing additional evidence of insurability. As a last, many insurance consumers only need to replace their income until they've reached retirement age, have accumulated a fair amount of wealth, or their dependents are old enough to take care of themselves. When evaluating life insurance policies for you and your family, you must carefully consider the purchase of temporary versus permanent coverage. As you have just read, there are many differences in how policies may be structured and how death benefits are determined. There are also vast differences in their pricing and in the duration of life insurance protection. Many consumers opt to buy term insurance as a temporary risk protection and then invest in the savings, the difference between the cost of terms and what they would have paid for permanent coverage, into an alternative investment such as a brokerage account, mutual fund, or retirement plan. Review this video over and over. This information doesn't change from year to year, and this is exactly what life insurance is all about. Thanks for watching the Shikama Live Show.